Did you know that equity release lenders can legally take more in interest than payday loan companies? That's right. While payday loans have strict caps on what they can charge, equity release schemes operate in a regulatory grey area, racking up six-figure interest debts before many homeowners even realise what's happened. The question is, should equity release be regulated like payday loans? Welcome to Factful Finance, where we uncover the financial traps that most advisors won't warn you about. Today, we're diving deep into home equity release, specifically whether the same tough rules that protect borrowers from payday lenders should apply to these lifetime mortgage schemes. If you or a loved one is considering equity release, you cannot afford to miss this. To answer this, let's break it down. What makes payday loans so dangerous? Simple. Extortionate interest rates, aggressive marketing, and targeting vulnerable people. Sound familiar? Because that's exactly how many equity release products operate. Take Sheila, a retired nurse from Manchester. At 68, she released £50,000 from her home to supplement her pension. The lender's glossy brochure promised no monthly payments and a stress-free way to unlock your wealth. Fast forward 15 years and that £50,000 ballooned to over £160,000 in debt, wiping out her children's inheritance. All perfectly legal. Compare that to payday loans. In the UK, the Financial Conduct Authority, FCA, introduced a total cost cap of 100%, meaning borrowers can never owe more than double what they took out. Payday lenders also face strict affordability checks and cooling off periods. Equity release? No such cap. No affordability test. And once you sign, you're locked in for life. So why hasn't the government stepped in? The answer lies in lobbying and marketing spin. Equity release is a multi-billion-pound industry, with firms pumping millions into advertising campaigns featuring trusted celebrities and reassuring slogans like safe and regulated. But here's the reality. Regulation does not mean consumer protection. Payday lenders are regulated too, but only after years of financial devastation forced lawmakers to act. Now, does this mean all equity release is bad? No. For some, it can be a lifeline. But if payday loans, short-term small-sum loans, warrant strict caps, shouldn't lifelong six-figure debts demand at least the same level of scrutiny? If you're considering equity release, ask yourself, would I take out a loan where the total repayment amount is uncapped, where the lender profits more the longer I live, where my estate could end up with nothing? If the answer is no, it's time to rethink. Before we wrap up, a quick but important reminder. This video is for education only, not financial advice. Always speak with a certified financial professional before making any major financial decisions. If you found this eye-opening, wait until you hear what's next. There's another hidden clause in equity release contracts that could cost homeowners even more than compound interest. Click the video on screen. You need to see this.